Look at the sheer chaos of a mid-20th century trading floor. For decades, the stock market was treated as a physical, unpredictable beast. But quantitative pioneers looked at this noise and saw a system they could measure. Fisher Black, Myron Scholes, and Robert Merton established the math for modern finance by modeling stock prices using geometric Brownian motion. This specific model ensures that a simulated stock price can double or halve at commensurate odds, but it can never drop below zero. Measuring this motion ran into an immediate roadblock. In standard calculus, integration and the measurement of change require paths to have bounded variation, a finite, measurable length. Standard calculus needs smooth curves to plot a clean tangent line. Stock prices follow the erratic trajectory of Brownian motion. Zooming into this path reveals infinite self-similarity. Because new peaks emerge endlessly, the stock's path length is mathematically infinite. Applying classical calculus to an infinite-length path breaks the underlying equations. It creates impossible market conditions where the math simply stops working. In finance, an arbitrage is defined strictly as a risk-free strategy that starts with zero capital, carries exactly zero chance of loss, and guarantees a positive chance of profit. Any valid financial model must strictly prohibit these risk-free profits. If a set of equations allows an investor to generate free capital, the model is definitively wrong. Standard calculus assumes that as we zoom in, every curve eventually smooths out into a straight line. If we apply that logic to a stock, it implies we can time trades to capture every micro-movement with perfect efficiency. Without a second-order term to account for energy lost to jaggedness, the math suggests harvesting volatility as a risk-free profit, a theoretical money-making machine. To correctly price financial contracts without breaking the rules of logic, standard mathematical rules had to be abandoned. Effective derivative pricing relies on the structural elimination of mathematical arbitrage, using stochastic calculus to bridge the gap between randomness and logic. The primary tool for building this new framework is the stochastic differential equation. This is the mechanism used to generate scenarios of how an asset's price will evolve over time. This equation splits any given price change into two distinct parts. The blue section isolates the deterministic average growth, or the drift. The red section isolates the uncertain Brownian movement, the volatility. Brownian motion possesses a specific property known as bounded quadratic variation. If you square its erratic increments, they accumulate to exactly the elapsed time. Because the squared standards significantly impact the final value, we need a specialized stochastic chain rule called Ito's rule. Whenever you differentiate a function of a stochastic process, Ito's rule forces you to add a second-order variance term to the equation. This new second-order term mathematically captures exactly how the squared volatility drags on an asset's price over time. Without Ito's second-order correction, standard models ignore the true cost of uncertainty. This single missing variable is what allowed theoretical arbitrage to exist. We now use this stochastic math to find the objective, fair price of an option contract. This pricing requires the assumption of a complete market, meaning any future payoff can be perfectly matched by buying and selling currently available assets. It also relies on a self-financing strategy. After an initial investment, capital is reallocated between assets without ever adding or withdrawing outside funds. This scale visualizes delta hedging. It is the act of building a replicating portfolio using the underlying stock and a risk-free bond to exactly match the value of the option contract. The bond in this portfolio acts as the numeraire. It is a strictly positive benchmark asset that simplifies the equations by removing the need to track a currency's fluctuating value. As the market moves, the volume of stock in the portfolio is continuously adjusted. These precise, continuous shifts are mathematically designed to perfectly offset and completely neutralize the Brownian uncertainty of the option itself. Because the portfolio and the option end up with the same payout, their current prices must be identical to prevent arbitrage. The singular fair price of a derivative is exactly equal to the cost of maintaining this replicating portfolio. Predicting which way the stock will move is irrelevant. If the stock's future direction does not matter, the model must still account for the real-world probability of that stock rising or falling. The fundamental theorem of asset pricing states that an arbitrage-free market requires the existence of an equivalent martingale measure. To find this measure, mathematicians use Girsanov's theorem. This provides the formal mechanism to legally alter the underlying probability measure. This animation illustrates Girsanov's theorem in action. It shifts the probability distribution from the real-world measure over to the risk-neutral measure. By moving the center, it mathematically deletes the asset's unpredictable real-world drift and replaces it entirely with the known risk-free interest rate. Notice the shape of the curve. While the drift changes location, the volatility parameter dictates the width, and it remains strictly unchanged during this mathematical transformation. Shifting to this risk-neutral measure proves the impossibility of beating the system. Under these probabilities, the expected future discounted price of an asset is exactly equal to its price today. By combining Ito's rule for volatility, the replicating portfolio against arbitrage, and the risk-neutral measure, the mathematical framework is complete. The result of this combination is the Black-Scholes partial differential equation. The PDE is constructed by weighing the hedging portfolio with a specific amount of stock, the delta, that exactly matches the option's sensitivity to price changes. This precise ratio ensures the random fluctuations in the stock and the option are identical. They subtract to zero, leaving a fully deterministic equation that can be solved backwards from expiration. Stripped of unknown risk, the formula only requires specific observable market variables to solve: the current stock price, the strike price, the time to maturity, the interest rate, and the volatility. The Black-Scholes formula acts as an unarbitrageable engine. It takes raw market variables and processes them into a singular, exact price for risk. But the Black-Scholes derivation contains a critical limitation. It assumes the interest rate is a flat, constant number. In reality, interest rates are governed by a term structure. Short-term loans and long-term loans command entirely different rates based on time and economic conditions. This 3D surface plot shows the yield curve. It maps out the implied constant rates for specific, varying maturities over time. Because this yield curve fluctuates randomly in the real world, the constant rate assumption fails. Stochastic calculus must be redeployed to accurately model fixed income derivatives. To do this, engineers use short-rate models. We simulate the instantaneous shortest-term interest rate, using it as the foundation to build out the rest of the curve. Pricing interest rate derivatives, like swaps or caps, requires capturing the stochastic motion of this entire term structure, rather than plugging in a single static input. Two foundational models attempt to map this short rate. The first is the Vasek model. Vasek applies a mean reverting drift. It acts as a mathematical gravity, pulling interest rates back to a long-term average if they spike too high or drop too low. However, the Vasek model possesses a structural flaw. Its constant volatility parameter allows simulated interest rates to unrealistically cross below zero. This required a vital evolution in the mathematics, resulting in the Cox-Ingersoll-Ross, or CIR model. This comparison shows the improvement. The CIR model dynamically adjusts the volatility component, forcing the jagged movements to mathematically dampen as they approach zero. This structurally bounds the rate strictly in positive territory. Today, advanced frameworks like Heath-Jarrow-Morton go even further, modeling the entire forward rate curve simultaneously to guarantee no arbitrage exists across any maturity. Financial engineering relies on the principle that randomness is bound by strict mathematical laws, making it possible to precisely quantify and price the cost of uncertainty.